Welcome to Smart Wealth. I am Joshua,
And I am Jane.
your daily stock analysis and catalyst talk. Today, we're looking at Pure Storage.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
All right. So when you look at Pure Storage, I think you have to start with the fundamentals. The numbers from their last fiscal year, 2024, they really tell a story.
They really do. I mean, the first thing that just jumps off the page is the top-line revenue.
Exactly. They brought in $3.17 billion. And, that's a solid number on its own.
But the context is key.
The context is everything. That was an 11.92% increase year over year. In this sector, that's really robust growth. It's outpacing a lot of the older legacy companies.
And what's really impressive to me is that it wasn't just growth for the sake of growth. It went straight to the bottom line.
Oh, massive operational leverage. Net income it surged. An astounding 74.09% jump. That tells you their cost controls, their efficiencies. It's all starting to click as they scale up.
And that's what lifted the EPS, the earnings per share, to about 41 cents trailing 12 months.
Which gives you a much better picture of the business health. But, if we look forward, that's where things get really interesting.
The analyst community, they're not just optimistic, are they? They're extremely bullish.
Downright bullish. They're projecting sustained double-digit revenue growth, something like 16.3% a year on average, all the way through 2028.
So they see this as a multi-year story, not a one-off spike.
Precisely. But here's the number that makes you do a double take. The EPS growth forecast for 2026.
Right. It's projected to leap over 540%.
540%. I mean, that doesn't just happen from selling more hardware. That suggests a fundamental change in their profit model is about to hit.
Which, that immediately makes me ask about the balance sheet. Are they taking on a ton of debt to fund all this?
And that's the beautiful part. Not at all. They have very low net debt.
Okay.
A healthy cash position, and, this is the key, strong free cash flow. So they're basically funding their own R&D, their own innovation without much strain. It gives them a ton of flexibility.
All right, so let's move past the numbers then. What's the engine behind all this? What's the competitive edge here?
This is where it gets really fun. I mean, they are a leader in enterprise flash storage. But what that really means is they're disrupting a decades-old industry.
They're replacing the old, slow spinning hard drives.
Exactly. They built their company on all flash arrays, super fast storage that you absolutely need for modern things like AI and, real-time data analytics. It changes the entire economic model for companies.
But other companies sell flash storage. So what's the secret sauce? What's the moat that protects them from the huge guys?
It's not just the hardware. It's the architecture and the business model built around it. It's their AI-optimized solutions and this thing they pioneered called the evergreen model.
So instead of a big capital expense for a box that's obsolete in 5 years,
you subscribe. It moves the cost from CapEx to OpEx for the customer.
And that creates incredibly sticky customers.
Incredibly sticky. It drives predictable, recurring revenue and very high renewal rates. Once you're in their ecosystem, it's a real pain to leave.
And you can see the market believes in that story. The sentiment right now is overwhelmingly positive.
Absolutely. The strong earnings beats in Q2 and Q3 of this year really poured fuel on the fire.
And then the analysts hiked their price targets. Citigroup went to 110.
JP Morgan and Guggenheim to 105. When you see all the big firms moving in lockstep like that, it's a very powerful market signal.
So looking at the chart, the stock's trading around, $86 and change?
Yeah, about $86.47, right near the top end of its 52-week range. It's a classic bullish trend, higher lows, higher highs.
And you're seeing the big institutions, the pension funds, and so on, increasing their positions.
They are. And maybe even more telling, we saw insider buying in September and October.
That's always a great sign, isn't it? Management is putting their own money on the line. They believe it's still undervalued, even after this run.
It suggests they see more upside ahead, which brings us to the immediate catalyst, the big event.
The Q4 earnings release, December 2nd.
That's the moment of truth.
It is, because this leads directly to the single biggest risk, the elephant in the room.
The valuation.
A PE ratio of 207.74. For anyone listening, that's extremely high.
Yeah.
The market is pricing in absolute perfection.
You've hit on the most critical point. A PE of over 200 means there's zero room for error. They don't just need a good report.
They need a huge beat.
A huge beat and phenomenal guidance for the next year. Anything less, And a stock with that kind of premium, it could see some serious short-term volatility. The market is not forgiving at these levels.
So besides that earnings report, are there any other catalysts we're watching for before the end of the year?
Two things. We're anticipating some new product launches specifically for AI-optimized storage, tapping right into that demand. And second, some potential news about expanding into new vertical markets, which would be good to see.
And long term, what are the big risks outside of just that valuation number?
Well, there's always execution risk. Can they keep innovating fast enough? And second is market concentration. They still rely pretty heavily on big enterprise cloud customers. If that spending slows down,
They would feel it immediately.
for sure. But long term, the macro trends are just so strongly in their favor.
The move to the cloud and the massive need for AI infrastructure.
Exactly. They are riding two of the biggest waves in technology right now. AI just consumes massive amounts of fast storage.
Any speculative buzz, M&A, or anything like that?
There's always some chatter. The market sees them as either a prime acquisition target or maybe more likely an acquirer themselves, trying to build out their software moat. There's also some talk about a push into edge computing early next year.
So bringing that high-speed storage closer to where the data is actually generated.
Right, another huge potential market.
So if you put it all together, the thesis seems strongly bullish. We're talking a 9 out of 10 rating.
Yeah.
But it comes with that huge asterisk.
A huge one. It's attractive for a short-term trader playing the earnings catalyst and for a long-term investor who believes in the story. But both need to be aware of the valuation risk.
So the essential question for you, the investor watching the stock now, is whether those upcoming Q4 results will deliver the margin expansion and the forward guidance needed to truly earn that premium multiple of 207. It's all about flawless execution in December because the market has already priced in the dream.